So here we have Renee and Dean. You can see them. And how I know them is I got a phone call in 2011 from Dean, and he said he and his wife Renee wanted to meet and talk about real estate investing. And so I scheduled a strategy session for them. And what I remember distinctly about that meeting is Dean had a book in his hand when they arrived, and it was a book about how to get wealthy investing in apartments. That's when I knew they were serious, right? They already had read the book and they were ready, and they just needed a little bit of help. So I love that, you know, that's characteristics that somebody who's serious, especially for you people getting started, you really have to be serious about this, because it does take some studying and it does take a real commitment to make it happen. Oh, they're both shaking their heads, right? So what happened is we jived at that meeting and we all decided, hey, let's work together. And what's cool is we're friends today because we've been working on this. And within a few months, I was able to put together a deal on 2 off-market fourplexes. They were side by side with a driveway in the middle and a common parking thing in the back. And they were able to get them, and today we'll say at a great price, but at the time, it seemed like it was, you know, it was the market price at the time.
Yeah.
And really that was the beginning. And, you know, I think, you know, Renee, you had said earlier that originally we started looking at some single families, and then boom, 2 fourplexes. That wasn't what you expected right away, was it?
No, when we originally thought for a building, we thought, let's start with the fourplex. And then when we start talking with you and we knew it'd be difficult to find the fourplexes, you're like, oh, okay, we'll start with single families. And then pretty soon LeAnn's calling, I have 2 fourplexes.
So you took a big gulp, right?
Yeah, right. Oh. Yes.
And what was great is, you know, off market is even better. We didn't have to duke it out, you know, as today, many of you know, it's low inventory and it's hard to get there first. Back then in 2012 is when they first bought that, and being off market, we had a little time to breathe and negotiate. And that really was only the beginning. So I'm going to ask them some questions of what really got you started.
Go ahead.
So, you know, LeAnn, when we talked, you know, back, it seems 7, 8 years ago now, a lot of what we were after is diversifying. You know, we had been obviously investing in the stock market and 401ks and stocks and playing in the options and things like that. Anything we could do to increase our, in the end, which would be retirement. And you know, we were looking for ways that we could invest in something that would be a little bit more of a cash flow, something that would pay dividends in the end. And obviously with the idea of retiring, you know, and I'm sure everybody online here is seen Mr. Kiyosaki and his quadrant. So we knew we were smack dab on the employee side. We wanted to get to the business side and the investment side in time. So that was really the biggest driving factor. And knowing real estate and where the market was, and knowing that is something that Renee and I could do together, we said that really makes the most sense for what we're looking at. So let's try it, see how it goes.
Cool.
Yeah.
That's great. And now, so you got going with those 2 fourplexes, and I'm sure it was like, uh-oh, now what?
Yeah.
And so there was probably a pretty darn big learning curve with that many units right out of the gate.
It was.
So
yeah.
Tell me a little bit about, you know, how did you figure it out?
Well, yeah. So, you know, you mentioned the book. So, you know, we started with that. And the book was really to, I guess, help us learn the vernacular of real estate investing. What things do we need to be thinking about? But then, you know, when we started looking at all of the other facets, thinking property management and maintenance and all that type of stuff, really, I think the biggest thing for us was to get into investment groups. And, obviously, one of them was with you on the personal group, if you will. But then we also just followed up on any other investment groups that we could and stayed at ones that worked well, especially ones where people were willing to talk about what things worked and what things didn't work, and kind of get around, if you will, those like-minded people. Right, is probably in the end, what helped. And then obviously talking to others that have, either the real estate experience, the investment experience, but also bookkeeping and the property management and legal and, rehabs and all the things that come with it, right? So it is really just studying that and talking to those folks.
Well, and Lee, your group, every month we were there faithfully.
I remember.
Yeah, definitely.
We always had somebody new that was going to teach us something, and we'd take notes and stay after and talk with them. And
and it's really great. And I'll continue this again because that's how I find my speakers. People ask me questions and I'm like, oh, I know somebody who can come and talk about that. And that's how I'll do these webinars too.
Yeah.
So it's okay to put some questions, or send me an email about that. Hey, I need to know about whatever it is related to real estate. And I'll keep that in mind when I decide who to have as guests.
Okay.
Now, how did you figure out who would do what duties, in this portfolio? How did you figure out between the two of you?
Yeah, so really it came down to us figuring out our strengths. What things were we good at and what things did we like to do? So we really had the discussion on that part of saying, okay, Renae is really good with people. So doing the property management, filling apartments and dealing with the interactions was just right up her alley. I'm a little bit more of a numbers guy and a fix it type of guy. So obviously maintenance and financing fell, onto my shoulders. And then any of the other stuff, it really just came down to her and I talking and saying, okay, well, who's going to pick up whatever it might be, dealing with the insurance companies or, all the other facets of things that come along. And so we didn't quite have to draw straws, I'm sure on some things, on what could be mundane.
You do that.
Yeah, exactly. Yeah. But it really worked out well in that regard.
It did. And I know for you, Renae, you had never property managed, but, before this began.
Yeah.
So how'd you figure it out?
Well, MHA, I went to class there, learning some of their housing information that we need to know. And then I know you had that gal that I sat with her that one afternoon and
Linda.
took as many notes as I could. And I just kept asking questions to people on things I needed to know. And some of it is just things you've got to figure out. As long as you're maintaining in the legal aspects, that's the big thing. But then some of it is just trial and error and seeing what works for you or work for us is how I manage.
Yes. And I remember at the beginning, exactly, really going over like some of those fair housing rules, you need a policy, that you operate around for property management. Yeah. That's like a fair housing rule. And I like that about you guys, because you figured that out in the beginning so you could run a system.
Yeah. Yes.
Yeah.
Very important. Yeah.
Yeah. It's always staying consistent, doing your, setting your own criteria and staying with that criteria through the whole thing. Yeah. Don't deviate from person to person. You've got to stick with it.
Deviations get you in trouble in property management. Yeah, they do. Yes. And I always say to people, you can have a soft heart, but you're still running a business. So keep that in mind. This is about the business first. And you can't give away the farm. It doesn't work. Then the numbers guy is going to be mad.
Yeah.
Yeah, Definitely. Okay. And then, how did you choose which market that you guys, what made it attractive to you to, I know you're pretty tight local investors.
Yeah. Yes, definitely.
How did you choose that?
Yeah, so knowing that we were going to do all of the work, especially in the beginning here, then Renae and I kind of sat down and had some discussions on, okay, how do we want to go about looking at the markets and what are we really looking for? So the first kind of the primary constraint was they had to be within, I'd say, about 10 miles of our house. So we had set a 15-minute drive was kind of the really the max that we would use, and saying anything that's outside of that we weren't even really interested. So that was kind of the first thing, and then after that, obviously it had to be a deal that the numbers would work, right? So I know you and I sat down and Renae some time ago and mapped out, okay, you got to think about the revenue and the expenses and all that fun stuff, and we would go through that exact thing, and we had some numeric criteria that we were looking for, and it mainly revolved around cash flow, and that was kind of our second criteria. And then our third criteria is that it had to be in an area that we felt would support the numbers that we needed for the rent. So it couldn't be like like we liked to get buildings that needed work. So if they're mismanaged or in bad shape, but we had to make sure that when we got them managed correctly and got them into shape, that then they would support the market rent that we were looking for, right? So we didn't want to be in a high crime area or anything like that.
Okay, so more of a B- neighborhood, that seemed to work. Working class neighborhoods work.
Exactly. Yeah, the working class neighborhood is really kind of our main target, but we'd get into some other neighborhoods that had, the crime rate wasn't too high, yet they're kind of right on that edge of working class, so we knew we wouldn't have too many problems, right? Because in the end too, we wanted good tenants.
You were happy if it needed some work, but not too much.
Yes. Yeah.
But I remember at first, but I remember the building in Lexington, and how many years were you in before it was a fourplex? Did you own several before you got that one? I can't remember.
Yeah, so that was about 2 years in. So when after we bought the 2 fourplexes that you mentioned in 2012, then we spent 2 years just kind of getting used to everything, getting our process, making sure that this is something we wanted to do. And I'd say about a year and a half into that, we said, yes, this is definitely what we want to do. It's time to start thinking about buying again. So then Renae and I sat down, we were having discussions. I prefer rehabs. Renae kind of preferred a little bit more of a turnkey. So we had to have a lot of debates. And we started looking for buildings that met both, essentially. And if you remember, we bought the fourplex in Lexington and then the 6-unit down in Columbia Heights. They were within a couple months of one another. Yeah. So the 6-plex was a little bit more turnkey, if we can call it that. And the 4-plex in Lexington needed a lot of work. So I was excited, Renae not as much on that 4-unit.
A kind of cool thing about that 4-plex, I remember, it was an estate. Someone had passed away and it was in a trust. And we made an offer. I remember this pretty in the 200s, if I remember right. And somehow, because of a bank involved in the trust, we lost it at first, but then it came back around, and then they lowered the price.
Yeah, they came down to our original.
How often do you hear that? They lowered the price, like we offered X and they came down some. Yeah. But hey. Yeah.
Well, and I think the other folks, their financing fell through, right? And I think they were trying to do some standard financing, and the place was not, it was rough shape, right? And it
wasn't occupied is what the problem was, because the guy had died, and there was there one tenant or 0?
2 tenants.
There was 2 tenants, one was leaving.
2 out of 4, and the banks don't like that.
No,
they don't like it to be not occupied. It's a bigger risk, but what the banks are happy about though is once you have experience, then they're happier to go along with something
Yes.
like that.
Yes. Yep. Yep.
Yes, I remember that.
Yeah.
Okay, and then any specifics on how do you manage all these, Renee? You're doing most of the management, you know, now that you've grown to 46, is it 46?
47?
47.
47. Okay,
Yeah.
now, I mean, that's it, you know, is that a full-time job now?
That is full-time, yes.
Okay,
Yeah.
it is to manage
Yeah.
47 because of the tenant turns
The
and
tenant turns, I do all the books, placing everybody, but then also we are still doing all the turns ourselves.
Yep.
So, you know,
she means the
daytime I'm doing.
she's
books.
talking about the repairs folks here, the tenant turns.
Yeah.
Like personally, Dean and Renee, do you paint?
We paint, do flooring, clean,
Do it all.
everything. Only thing we don't do is put carpet down.
Yeah, we
lay
got a good
carpet.
carpet guy.
Yeah.
So see there, that's one of the ways you've been able to grow fast, right?
Yes.
Yes. Yeah.
Because you put in the sweat equity.
Yeah.
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 Yeah. You remember some time back, we were talking velocity of money. That's something that we put to use, and we set a pact that as we're doing these turns, or as we're buying buildings and making the cash flow in the buildings, we would turn that cash flow into another building. You know, so the whole idea was build the portfolio as fast as we can, and organically. So our plan was not to have other investors. It was just to work with our own money. So that was
by putting always the money back into the business and your sweat equity, that has allowed you to grow at this level without adding more to the kitty all the time.
Right.
Yes.
Yep.
That's huge. That's huge because I know the latest acquisition. I mean, I know this, guys, because I was their realtor, so I know how these deals work.
Yes.
The latest acquisition is it 12 units or 11?
It was an 11 unit. Yeah.
11 unit building. That takes some serious dough down.
Yes.
And because you had always put the money back in, like you said, it was growing and growing.
Yeah. Yep.
That's really
well, we still do loans on each building, but
obviously,
you know,
but
payment comes out.
But the down payments are big.
Yes.
Yeah.
Yep. Yeah, you definitely have skin in the game.
Oh, we got a question here. Let's see. How did you fund your first and second purchases?
So our first purchase, we had cash, of course, that we had saved up, but then we also dipped into our 401k. So we had money that we could loan out. So we didn't extract the money, but we took a loan against it. And in that regard, you pay yourself interest. So it was kind of a nifty situation. And then we also took out a HELOC, so a home equity line of credit on our house. And the whole idea was, especially once we found the 2 fourplexes, right? So our plan was a single fourplex, you know, but so we had to kind of get a little creative to get both of them at that time, you know, but that's really what it came down to, is just leveraging, you know, anywhere that we could get access to money is how we ended up pulling that off. And then our second purchase,
let the money build up a little.
Yeah, exactly. Yeah. So for that 2 years, of course, we're letting the cash flow build up from the first purchase. And then we also, of course, were saving our own money. So that's basically how we put those other 2 deals together.
So really the biggest stretch was on the first one.
That one was, that one we ended up draining anything and everything that if there was money somewhere, we'd use it.
You know, I remember that in building my big portfolio, the same thing. It takes the first one is like the hardest. Yeah. And once you can get over that mountain, it's a lot easier from there.
It is. Yeah, it really is. Yeah, it's also the hardest mentally, right, to jump into that, you know, because that's a lot of money. I mean, it's one thing when you buy your own house, that's already a lot of money, but then to buy another building like that is definitely a mind shift.
Yeah.
But it's a good thing to do.
Someone is asking here, Annie is, when you buy properties that are 4 or less units,
Yeah.
aren't the lenders looking at your personal DTI, debt to income?
Yeah, yeah, they are. So even our commercial, we have residential loans in that regard. So well, all of our 4 and less units, with the exception of one, are residential loans. One of them, the building in Lexington, we bought on a commercial loan. But the others are residential loans, and they are looking at you. I mean, all of them, you guarantee it. So they're still look at your debt to income, even with personal or with the commercial. But the residentials, they're very, very strict in that regard. So they look at your debt to income. They look at, of course, you know, how many loans that you have out. They're very extremely thorough. Yeah, and hard to work with.
And you have to fit the box.
Yeah.
Fit everything perfectly.
Yeah.
Yes. And one of the things, though, your strategy has been always to buy something that is under rented.
Yeah.
Yeah.
Do that, put a little new carpet in the hall, do that, juice it up, but
Yeah.
not super, nothing like granite countertops or anything, but just
No.
No.
juice it up, clean it up,
Yep.
and then raise those rents. So therefore they counted that income too, right?
They do, yeah. On our first purchases, they didn't,
Right.
because we're new, of course,
Right.
to it. But after that, yes. Then they, if I remember right, on a residential loan, I believe they include 75% of your projected income on that property, if I remember right. You know, so they'll include. They won't include all of it, but a good sized chunk of it. And then, of course, they look at you know, your guarantee. I mean, you're still guaranteeing, so they're going to look at your debt income, as the last person asked. And then they also, you know, on the residential loans, it's a little bit more like buying a house, right? So they're not looking at the financials of it so much as they're looking at the comps, right? So they want to.
You had to keep yourself stellar, and there's no go buying new trucks, right?
Yeah,
You had to keep yourself stellar in
Yes.
order to roll this.
Yes.
Yeah.
Yep.
I really get that. Yeah.
Yep.
Now we have some questions for you, Renee, about how do you find and qualify your potential tenants?
Oh, yeah.
Oh, we have a criteria, and so we set that from the very beginning and stick with that. And then I run everybody through, we screen everybody. So everybody has to fill out an application, and everybody gets put through. It's a agency that I use. It's like, you know, they have them out there.
What's the name?
Rental History Reports is who I use. And I've used them since the beginning. So, yep, everybody has to fill out the same forms, and you stick with the same criteria for everybody. Well, what else was the question?
And, yeah, and then where do we find?
How do you qualify them? I know I taught you a particular script on the phone, and I know you've told me this. You can find out a lot about people on the phone.
Oh, yes. Yes.
If you ask the right questions, and you can narrow it out so they don't even have to come over and look. You already know it's a no, but you have to really have a finesse about that. And I know you have that now because you've learned that over time, haven't you?
Yeah, yep. Every phone call, I pre-screen over the phone. And then I go through my list of questions as far as what our criteria is going to be, making sure that they meet that. And a lot of people will just talk, and you just visit, and then you set your showing time after that. And I always make them call an hour prior to the showing, because that way you're not just sitting at the apartment waiting for them to show up. And if you don't get that phone call, you just know that they're not coming.
It's not a good tenant.
Yeah.
The other question from Eric is, what's your vacancy rate right now? Out of your 47 units, what's your vacancy rate?
So we have, we've had a lot of turns in the last 4 to 6 months. So we've been extremely busy, as we have talked, LeAnn. But right now we have, I don't know how, I think we have we have 5 apartments that we have listed, but I think 2 of them right now are open. So the tenants have already moved out, and we've done we're working on the turns.
So they're already rented.
Yeah.
So you have 2 open and the rest are like already rented. It's just 6.
Yeah, we're just going through.
Yeah.
Exactly. Yeah. So we've had a lot of tenants, a lot of our longer tenured tenants, a few of them have been buying houses. In fact, I think most of them.
Like 5.
Yeah. Yep.
4 or 5
And then
people.
we had a couple tenants that we were working on cleaning house on some areas that we needed to clean house. So some of them are due to us just not extending the leases.
And I know too, when you buy a new building, you calmly go in there, but over the first 3 months, you figure out who's who, but then there can be some cleaning house.
Yes. Yep.
Yeah.
And there's raising rents, and sometimes that gets rid of them too.
Yes.
Yep.
Okay, now Annie, see, we got lots of questions. I got to make sure I get to, I think they're asking the things I was going to ask. Do you ever think you'll make the switch to using a property manager?
Oh, that's hard to let go.
I won't.
Maybe,
I've got a property manager.
I think I would start my own.
Yeah, you know how now.
Yeah. So, yeah.
It's funny is that we have debated, we obviously you always have to challenge everything that you're doing, right? So the last thing you want to do is become complacent, but we've challenged that every once in a while saying, does that make sense or not for us? But at the end, we always come back to the same answer, is that if we're after cash flow, or if we're after building a portfolio, then we're better to do the sweat equity and start looking at building the capability to have others help on other areas that we need help. And really the property management is probably one of the last areas, because we know who we're placing then, right? So it works much better than having somebody else do it for us. And they charge a lot.
They do charge a lot.
If there's property managers on here, but yeah, they charge a lot.
Well, I always say, Renae is doing that job, but it's your money that's going back into your pocket.
Exactly.
Her doing that allows you to grow faster.
Yep.
Yeah.
Yep.
Yeah. And you actually have more control over what's happening with your money.
Yes.
Yes.
Yeah. We got a couple questions about those darn loans again. Tim wants to know, are those loans borrowed under your own name, or do you have an LLC?
Oh, sure. So all residential loans, by definition, go under your personal name. So unfortunately, you can't buy it with an LLC. Commercial loans, they're all under LLCs. All of our residential loans, we have LLCs for the companies. So we manage, essentially each building is its own LLC or its own company. And we keep everything separate. So we do not commingle anything anywhere. So they're legitimate separate companies, own checking accounts and savings and all that stuff. But then what we do on the buildings is that if we buy a residential, we'll buy it under our personal names, and then we quit claim the deed or the title into our LLC name, usually right at the same rate when we close. After the banker is gone, of course, because there's a due on sale clause, right? You got to be careful not to trip that, but that's usually how we'll do these. But now our commercials, they're all, the building and the loan is under the LLC, but we still personally guarantee it.
Right. And yep. Okay, and so LLC is the same as a corporation, more or less, to answer somebody else's question.
Yeah, similar. Yeah, corporations, we have not done any, we don't want to run as a corporation because of the taxes and things like that. But
so LLC is the answer there.
LLC is what we've been doing. Yeah. Now, Renae mentioned a property management company. When we create that, we'd probably do that as an S Corp, we think. But that's something that we'll see.
Okay, if you're local, think about that. They might property management. All right, now let's see. Oh, Annie wonders here, when we talked about you buy something that needs a little bit of fixing, they said, don't you have to do a 203K loan in that case? I would say, Annie, my answer is if you're a brand new investor, yes. But when you have a record, and you're working with the same finance people and they realize you know what you're doing, there's flexibility there. And,
Yes.
and you have your own money to do the fix up. You're not
Yes.
borrowing the fix up money. You're
No.
just closing on the building and then using
Yep.
your own money for whatever the rehab is.
Yeah, exactly.
Well, and a lot of it is that the building and the apartment's already full. What it is we'll, as people leave, we'll do a rehab on that
Right.
apartment. So we're not kicking people out,
Right.
you know, it's fixing them as people leave.
Yep.
The
Touching up
only
in-
building that you really did a big rehab was that one in Lexington, and that's
Yeah.
because it was half empty
Yeah.
and it made sense.
Yep.
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 Yeah.
Yep. And that one we figured out with our own cash, of course, running the financials. I mean, that had to be part of it, you know, knowing that we're putting cash into it. But
Okay, now I've got a question here. Let's see. With 47 properties that are leveraged, what are your thoughts on the potential downturn in the economy? How would
So
that
we're
affect you?
yeah. So, okay. So first of all, we are, we're always very careful that we're not leveraged too much. In fact, that even goes back to when we rehab a building. I prefer to put our own cash into it because we know that we're getting equity in the building and therefore reducing our leverage. So we're always after that. Secondly, I'm looking forward to a downturn because we want to buy more. And yeah, the market turns down, it's opportunities. You know, so, you know, we know we're going to buy and hold. So, you know, obviously on our commercial loans, you know, there's terms. I mean, every 5 years or so, we have to renew the loans, but that's 5 years from now. You know, so your equity, of course, you're paying down that equity right over those 5 years. So yes, keep an eye on it. You only leverage yourself as far as what you're comfortable, especially because if things turn around, especially, you know, if rentals drop, right? I mean, you don't know what's going to happen to the rental, you know, the revenue side of the market, you know, so we definitely keep an eye on that.
You know, I always say to people, if you're cash flowing at the right amount, a downturn isn't going to hurt you that bad because you're always paying down that mortgage, just like, you know, with those tenants, and you are you're above the water, and it doesn't matter if the building value goes down, as long as you're in the hold pattern, eventually that building value will catch back up. And we've seen that. It's even in the time you've been investing from 2012 to 2019. The price that we paid for those two first fourplexes, and remember, what, 2 years ago, you bought the one on the corner. In the same street, and you paid a lot more for that one, didn't you? Even though we got a good deal on it, you still paid a lot more.
Definitely.
But the numbers still worked.
Oh, yes. Yeah, the numbers have to work. I mean, that's, you know, if there's anything that I would say, it's make sure the numbers make sense. You got to think the leverage, you got to think the cash flow. And if they don't make sense, don't buy it. You know, just go look for a different deal.
And when you speak about that leverage, would you say, you know, do you like to stay at like 75%? Is that where you like to kind of feel comfortable, or even less?
Yeah. So now I'd say we're maybe a little bit more aggressive if we get, like, because we have some contract for deeds, of course, that we leverage more than 75. But if you look at a residential loan, by definition on a fourplex, it's going to be 75%, right? Yeah. You know, outside of additional cash if you put it in. So for us, I'd say for the most part, it's 75% on the resident. Obviously it's less now, you know, as it's been years, but on our commercial loans, you can do 20% down. So it's a little different. But the difference too is that they amortize over a shorter period. So you're putting money into the equity or into the principal faster, right? In other words, you're paying down that leverage.
Yep. Okay. Let me look at my questions. What do you do about problem tenants, Renae?
Oh, what do I do? It all depends on what the problem is. But for the most part, I first talk to them, try to reason with them. And then after that, I'll put in their file, you know, whatever it was. And then we have evicted. Hasn't happened very often in 7 years, but we have evicted. Yeah, or we just don't renew the lease.
Yeah.
So that's typically the easiest way to go, because we do month-to-month leases with 60-day notice to leave. Well, we do a year, and then we'll go month-to-month with 60-day notice. So we'll just not renew, and then
If they're a problem.
they're gone.
Yeah.
Mhm.
Right. And I know, because I know you guys, you've had to deal with problem neighbor buildings too.
Yeah. Yes.
Yeah.
You know, that affect your building. And that's what I would say to all you on here, you beginners. If you're buying a multifamily, you really want to sort of watch what's going on next door to yours too.
Yeah.
That's part of it.
Definitely.
Yeah.
So
I started when we would call. I haven't been as often now, but calling the police station, because you can get the police report on the particular building or the area, and we would always do that.
okay, and let's see. Christopher wants to know, are there multifamily deals to be had in today's market, or would you recommend holding off until a downturn?
I would not hold off. Definitely they're out there. They're just hard to find. So the 11 unit that you mentioned, you know, we closed on that in December. And we had been looking for a long time. And when that popped up, the numbers made a lot of sense.
And that one wasn't even on the market.
Right.
That
No,
one,
it wasn't.
that one was, we went to look at they had an 8-unit listed. So we went and looked at the 8-unit, which we weren't crazy about. But then the realtor said something about having another building.
Yep.
And so we asked to go look at that. So the three of us and, you know, LeAnn, us three, we went and looked at the 11-unit.
Right. I mean, that's one of the ways we realtor find deals, is because just talking to that realtor, we went right after the 8-unit showing. We said, okay, we're ready. Let's go now. And he took us over there. And I think the next day we wrote, you know, we bought it before anybody else could see it.
Yes.
But part of that is Dean's our numbers man. He knows the numbers well enough that we could tell, ooh, this is good. We've got to stalk them till we get it.
Go fast. We had that
You can't wait too long.
No,
you can't. And, you know, I know there's one building that through networking from Renae knew somebody who knew somebody like that. They actually found one that was never on the market too, a fourplex that you bought. So you can never stop looking. And the other thing I would say, what's great about Dean, he's ready. You have to have your finances and your everything in order to be ready. And we snagged a deal on a holiday weekend one time because we were ready. So let's see here.
I'd say, in fact, you know, with that in mind, you know, one thing that's worked very well for us going back to financing is that once, you know, first, definitely you need to find a bank that will work with you. And by that, you know, you got to shop for rates. Obviously, you want to find a good rate, but it can't all be about rates. You want to make sure that they've worked with investors, because it's a different, different.
Absolutely.
Right? And then the other thing is have a personal financial statement put together for the bank. You know, so all of your debt, all of, you know, your income, your debt, your assets, whatever, put it on paper, because that helps speed things up, and it puts you in a different light with that financial institution, and to the point where they're willing to work with you, because now they know that you have everything put together, if you will, and they're willing to write. I mean, you've seen they write a pre-approval the same day. Right? And that's important.
You know, I just did a refi on my own house, and, you know, I had a digital file I sent to the guy, boom. And that's what when I had my big $14 million portfolio, that's what I did. It was all digital, and this is back in the days. But that was important, because that's what that banker wants. If you've got yourself organized that well, then they know you can handle growing.
Definitely. And I think too, then they're willing to bend the numbers a little bit, right? Because, you know, when we're buying buildings that are, you know, way under market rent, you know, then as they're looking at what that building is making versus what they expect, they're willing to kind of work with you a little bit more and
Knowing that we're going to build it up.
exactly. Yep.
Well, because you have a record of that. Well, and that's
Yeah.
the trouble, speaking from the realtor point of view here today in the market. They price these buildings as if they're at the new rent, and they're
Yeah.
not there yet. And,
Yes.
you know, they want you to pay for that blue sky, and
Yes,
it's
they
hard
do.
for bankers to get that. And you have to be able to see how much can you raise those rents and how quickly, because that's, and maybe you don't make as much that first year, but from
Right.
then on you will.
Yeah,
Definitely.
a lot of times when we buy a building, it'll take a good year before we can get it to
Yeah.
where we want it to be.
Yeah, it's still cash flowing when you buy it,
Yeah.
but barely. Yeah.
Exactly.
Okay, we have someone who's asking, is there a maximum number of units you'll keep your portfolio at?
No.
No, yeah. So we're right now we're at a max that we can do by ourselves. You know, so if you think of hitting a ceiling, we're hitting a ceiling on time because we're basically maxed out. Now, as we start to remedy that, which we're certainly working on, then we'll be back. We want to buy more. So how many? We don't know, but we'll just keep buying as we can work the system around it. Yeah.
That's good. Couple people are asking about some local banks, and I believe I recognize them as Minneapolis names. I'll probably answer that offline to you folks because I don't want to put it on the webinar.
Yeah.
Right?
Yeah.
Although our bank would probably like it.
Yeah, they probably. So, you know, and I'm right with Dean, you have to go to the investor friendly banks.
Yeah.
The ones who really get it, because then the doors are open as far
Yeah.
as real estate. If you go to certain big boxes, I'll call them,
Yeah.
they don't understand it and they're not willing to work quickly. And that's what you need in this world.
Yes.
Yeah.
And then you have a lot of work on your own plate, you know, because you're constantly explaining things and rehashing things, and it's very taxing on your time and sometimes your patience.
Yeah. And someone says, do you purchase properties only local? And you do. That's your strategy. You
That's
want to
our
be able to drive over there and work on it.
Yes.
Okay. And somebody says, do you have a cash flow percentage that you sort of look for, a rule, you know, 1%, 2%, 3%? What is it?
Yeah, we do. So we it's kind of hard to answer because when we look at a building, I run numbers extremely conservative. So in other words, I want to make sure that the revenue, I don't put in a number that I'd like to see. I put in a number that I think is somewhat reality, maybe a little bit under that. I also put in a 5% vacancy rate, which in today's time, you know, day and age is high. You know, in other words, 2%, 3% is kind of the average. And then we also keep the expenses on a little bit on the high side, you know, assuming that we're going to run into something that you don't know. So with that in mind, we're typically look for somewhere between a 10 to 15% cash flow is the numbers that we aim for. And again, that's assuming that's sweat equity, right?
Yep.
So back to somebody asked about a property management company. They'd eat that 10 to 15%, a big portion of it pretty quickly.
Okay, somebody says, would you recommend buying something out of state? It's Wing. Hi.
You know, I mean, we don't have personal experience, so it's hard for me to recommend that or not recommend it. But certainly, you know, from other investors that we talk to, that's strategy that has worked for them. Obviously, we did. If you remember, we traveled to Milwaukee one point in time.
Yes.
Right? So we did look at properties there. We debated on it. In the end, obviously, we decided not to. But that was just primarily because we were still finding deals here that met our strategy. I will say in the long run, you know, looking in the future, it's highly likely that we'd start to look out of state as well. right? Especially as we start growing and saying, okay, maybe there's other investment opportunities. So
if
it's
summer, we want a winter part-time.
well, there's that too.
Yeah,
So maybe
second home, vacation homes.
That's
Yeah.
right. Yes.
Okay, let's see here. Oh, I had a good question. I wanted you to tell, you told me a story here when we were doing our prep about, what's some of the weird things that happen when you have buildings and tenants? Like what happened this last weekend? Oh my gosh.
Yeah. So when we were in Wisconsin, we just this is on
4 hours away.
a long weekend. Yeah. So we're by Green Bay, and we decided to stay another evening. And that evening is when the storms rolled through Minneapolis here. So this is last week. And a tenant had called us that evening at about 11:30.
Text me.
Or text us, text us that he thought the building was struck by lightning. So of course we called him right away, and we were talking back and forth trying to understand what was happening. Well, the long and short of it is that lightning did strike, but it didn't hit our building. It hit a tree that was 2 yards, two doors, so 2 buildings down, and the tree literally exploded. So it was a big oak tree, so the base of the tree is probably 2 feet or so. But a chunk of the tree flew across the building between us and hit the side of our building. So that's what the tenant thought was the lightning. But the chunk of wood was probably, I'd say, about 4 feet long and maybe 6 inches in diameter. So it had to weigh at least 50 pounds. And it hit our wall so hard that it knocked the 2x4 in the wall into the apartment and, busted the sheetrock and stuff. And that's the noise that the tenant heard and knocked his bed around and things like that. So he was a little shaken up. But, so that's just one example of funny things. And if I didn't see it myself, I would have never believed that lightning. I would have thought, tornado or something else. I don't know. But that was our crazy adventure here a week ago now.
Well, we went there the next day when we got home.
Yeah, when we got home, yeah.
And checked it out. What's great though is once you've been a property manager of your own buildings and a landlord, you learn that things do happen.
Oh yeah.
They just do.
Yeah.
And you learn to be more calm. And like you said, it wouldn't have done any good to run home.
No.
And it wasn't water. Water's the worst damage. There wasn't water in the apartment.
Yeah.
So you were okay.
Yeah. Yep.
Yeah. And that shows to me, that's what experienced investors are like. That's how you handle things.
Right.
You get it handled, but you don't panic.
Yeah.
Yeah. That's a big difference.
Oh yeah. Yeah. There will always be problems.
Yeah. We have a question here from Davy. When you're looking at a property, what resource do you use to research raising the rent? How do you figure that out?
Oh yeah.
Well, Craigslist, we do market analysis. So we'll use Craigslist, Zillow, and then just see what the rates are in the area, so you know what you can raise them to. And you have to look at the pictures so you know what, compare apples to apples, your apartment looks like compared to another one similar.
And I know you guys, you tend to put LVT flooring in, right? In like the living dining areas, right?
We do. Yeah.
Yep. And carpet. We're still doing the carpet, living room, bedrooms, kitchen, dining areas are the LVT.
Yep.
Just try to, basic spruce up.
Yep.
Yeah. Paint. Clean.
Mm-hmm.
Yeah. It doesn't take a lot, does it?
No.
It doesn't.
Yeah. I also would suggest Rentometer to check your rents. A lot of times when we buy a building, I send you the report because I subscribe to Rentometer.
Yep,
and
exactly.
That gives you, I love that tool because this will work for anywhere in the whole United States. It doesn't matter. And I was just doing one yesterday on a small little town and it still gave me the answer.
Yeah, definitely. Yeah, and you can get the feel, when you look at a tool like Rentometer or look at Craigslist or Zillow, after you've looked at the numbers for a while, you kind of get a feel for what that market will bear, within reason. It's not going to be perfect, but close enough.
So if if your answer said rent it out for 1,000, would you go 999 or would you go 1,050? Like, do you try to get the top or do you go
No.
just under it?
Yeah, we like to stay a little, I wouldn't say
Not
at
the
the lowest, yeah, but a little bit below what we feel is kind of the average or the lower part of the average. You know, so we're not trying to push for the highest amount of rent, for example, and not the lowest either. Right.
Yep.
So, you know, if you think best value, you know, so we want to give a tenant a really good value, you know, for the money that they're coming in with. So when we're comparing apartments, we already know that we're going to paint it and put carpet and LVT and all that type of stuff. But we'll still look at apartments that aren't, you know, really fixed up a lot, just to kind of get a feel for that side of the market. Because now we know that our apartments will be in better shape and then similarly priced.
Yep. Okay, we're getting to our wrap up. I'll quick answer. The Rentometer is a software program. Just Google it. You can use it like 3 or 4 times free and then you have to pay. One last question here. Oh, do you limit your rent increase for current tenants or do you just always rate it as it every year if they're staying?
I do not raise every year. Some people do. We just do every so often, couple years, just to keep them there.
Yep.
Yeah, because then you don't have to do the turns, but on a turn, you'll raise it considerably.
Oh,
That's
yeah.
really
Turn.
where you make your money, right? On
Yeah,
a turn.
definitely. Yeah. Yeah. Because even when we buy a new building, you know, with the existing tenants, if they're way below market, we will raise their rent, but not to market. You know, because chances are their apartment is not as in good a shape. You know, plus they've lived there for a while, so we don't want to try to, you know, get as much money as we can. Yeah, and we're not looking to displace them. Now, if they're a problem tenant, you know, then we just don't renew their lease. But you know, but most tenants are good, so we want to be fair.
Yep. Okay, then I'm going to ask the last question here. So, what would you recommend for someone just starting to build a portfolio? Is there any tools or what got you over the hump? What would it be?
Coaches.
Yeah.
Definitely coaches.
Yeah. Don't spend too much time learning. You know, you want to spend a little bit of time, but you want to buy. I mean, you're better. My feeling is you're better to buy something and not make it as much money on it. I mean, make sure that it's positive, of course, but you know, that you can learn more when you have it, because then you're kind of forced to learn. That is what I'd say is the biggest thing. And then commitment. You said it, you know, at the beginning of the webinar, we kind of chuckled because we know you got to be committed to it.
You do.
Yeah, it can't. If you do this as a hobby, you know, you get out of it what you put into it, I guess is the way to say it.
Yeah.
Right, and so you got to be committed.
That's cool. And this retirement is a lot closer now, isn't it?
Yes. Yeah. That's the goal. I mean, in the end here, we want the cash flow. So yeah, we can retire and we'll still do this. And we'll forever be landlords, but you know, we'll just build it to where we're not as hands-on, if you will, and we can do more of working on the business instead of in the business. You know, if you think of that typical quote. So. Yep.
Okay. So, and I love that you said coaches because you need a good realtor too, right?
Yes.
Right?
Yes,
Oh, yes.
you got it.
Well, LeAnn, you are the realtor, the coach, calling at 10 o'clock.
I know we've had a lot of late night chats, haven't we?
Yes, we have. Yeah.
So here's how I want to wrap it up is, you know, over the past couple of years, I have refined this same process that I taught to Dean and Renae, and it's called my proven profit formula. And I've been coaching clients nationally on this formula and how to get started. That's why I said hi to some of those folks there, because I know who you are and it really makes a difference. Get the learning down to what you really need to know and get a building. I love that, Dean. Thank you for saying that. So I so appreciate you two. And you know, we have a lot of fun together, but to just come and really share what it took to get where you are, because it's pretty amazing. And that book you brought, you know, that day, in 2011, and here you are now, you know, really, really rocking it.
Yeah.
Oh, thanks, LeAnn.
Yeah, thanks.
It's great to talk to successful people and figure out how did you do it.
Yeah. No, glad we could be. Yeah.
Yeah, I hope we answered some people's questions.
Oh, I think you did. And all of you who came to the webinar, thank you so much, because I love that you came, you participated, and this is what's so nowadays, yeah, we all see webinars, but not very many are live where we get to really participate. So thanks for giving this a shot, trying it out. And just so you know, I'll be sending you an email with a replay link. And I see, Aaron, you came on late, so you're going to get the replay and you can figure that out. And then if you want to book a strategy session with me, there's a link for that too in the email. So thank you all so much for coming on. And remember, the first Wednesday or second Wednesday of October at 7, and you'll get some emails. I'll have a new guest speaker, and we're going to learn more about real estate investing. We'll see ya.
Bye.
Bye-bye.
Bye.